Hi, my name is Thomas Kenney, and I am a junior at the Bishop School. Today, I'm going to be pitching Okta, which sells identity and access management software. So, you might be wondering, why, when I could have chosen thousands of other companies, would I talk about something as boring as identity and access management? Well, the answer lies actually in that sentence. Boring. You see, identity and access management is boring, but because it is boring, Okta and its services are severely undervalued, and because of that, there is actually huge opportunity. So let's get into it. Our brief company overview, Okta is a technology service company, and it is in the cybersecurity sector. They sell identity and access management software for a subscription service. But what makes them truly revolutionary is a couple of products. Under the Workforce Identity Cloud, they have single sign-on, or SSO. And what this does is it enables users to access all of their applications from any device with a single entry of one single set of user credentials. What this means is instead of having hundreds of different passwords to different softwares or accounts or applications, all of them are simplified into just one password. But also, Okta FastPass. Okta FastPass provides almost passwordless authentication through using biometrics. So imagine using Face ID to get into your school website or getting into your email. The fact is that Okta FastPass is revolutionary in how it is simplified logging into softwares and services. And finally, a huge strength that Okta has is that it is applicable with literally every operating software out there. Okta works with Amazon Web Services, Atlassian, Google, Microsoft 365, and anybody you could think of. Okta is compatible. So with that said, this is my investment thesis. Firstly, I recommend Okta because it is extremely low valued and undervalued, but it is doing extremely well financially. Secondly, because the industry that it is in will skyrocket in the future. And finally, because the technical analysis is quite favorable. So right here, we can see a chart of Okta's stock price from 2021, where that red line is, and all the way to the present date, where that green line is. And what we can see is that at that red line in the 2021 period, Okta was trading at around $235 a share. Right now, they trade at $110 a share, at basically half the market cap. But when you look at the financials, it becomes clear that this is not justified at all. In Q2 of 2021, revenue was $315 million, net income minus $276 million, and free cash flow margin of minus 1%. When we look at Q4 of 2024, most recently, we've seen revenue more than double to $682 million. Net income go to a positive $23 million, which is a huge leap, and a free cash flow balance margin of 41.6%. This is huge, and it represents immense financial growth for Okta, despite it being valued nearly more than half of what it was valued back in 2021. And it's further demonstrated by this graph. We can see in blue the revenue as it's steadily increasing quarter over quarter over quarter. And free cash flow margin, we can see at its record highs. All the while, it sits at half the valuation as it was in 2021. But it doesn't just stop there. Let's look at some of the other strengths. Since last year, remaining performance obligations, or RPOs, have gone up by 25%. What this basically means is that the contract value of the subscriptions that Okta is currently being paid has gone up by 25% in one single year. This is huge growth. But also, looking at Okta's stock, it's held 85% by institutions, which of course perform very well. Its product doesn't require any physical logistics, as it is just software, and it is an $80 billion total addressable market. Also, when we look at losses and financials, we can see that although Okta has struggled with losses in the past, the fact is that their free cash flow margin has steadily increased from these periods, and a lot of the losses, quote unquote, are just them reinvesting their huge free cash flows back into their business. And so overall, Okta has really grown financially and is again extremely undervalued. But let's look at some catalysts. Firstly, a big catalyst is passwords and identity increasing in importance. You and me, Judge, have more and more passwords every single year, and the same applies for every employee and every workforce and every single Fortune 500 company out there. The fact is that Okta's services will be in need for years to come. Secondly, the growth in the software as a service industry is projected to go around 20% every single year. And this is primarily because of AI. Okta uses AI to secure identities and to make its softwares more user-friendly. And while previously investment, for example, with NVIDIA was focused on making GPUs and making on hardware and training AI models, the next wave is going to be selling AI products, selling software as a service. And Okta will hugely benefit from this. Finally, AI agents. AI agents are basically human-like robots that will operate in computers and automate very repetitive jobs for humans. And by 2030, it's estimated that over 50% of enterprises will use AI agents in their business. And in the most recent earnings call, we've seen CEO Todd McKinnon touch on this. He emphasized the importance of Okta's identity security solutions in securing and regulating who and what these AI agents will be able to access. As AI agents rise, Okta's demands will rise as well. Next, let's look at some competitors. So Okta has around 25% of the identity and access management market share. Microsoft has around 22%, OneLogin 50%, Ping Identity a lot less than 5%. But Okta is different in that its services can be applied across any other software out there. Microsoft only works with Microsoft, for example. And also, Okta has heavily prioritized customer experience, leading to positive reviews and leading to it being trusted by more than 2/3 of Fortune 100 companies. Next, let's also go through some risks. So, Okta identified the following risks in their annual 2024 report: financial risks, competitive risks, operational risks, and macroeconomic risks. What all these risks basically focus on is the possible impact of losses returning. Okta has had losses in the past, but again, with these huge free cash flow margins, actually their losses aren't really losses at all. Rather, what they've been doing is simply investing every bit of cash they got from revenue and putting it right back into the business. So while yes, net margin doesn't look incredible, it's because they're reinvesting all the cash, and it's because they actually have the cash that these risks aren't too bad. Next, forces. I rank Okta a 4 out of 5 for competitive rivalry, supplier bargaining power, buyer bargaining power, the threat of substitution, and a whopping 5 out of 5 for the threat of new entrants. The fact is that Okta has unique products, it has customer loyalty, and it has incredible products that will be able to, they're not replaced by other competitors, and ultimately will continue to set up growth for growth in the future. Next, our target price. My target price for Okta is $180 per share, which is a 60% increase from now. This comes from the Fibonacci level of 50% from the previous rally, as you can see, and it's projected to grow basically right there, according to another analysis known as the discounted cash flow analysis. According to that analysis, with only a low terminal growth rate of around 5%, Okta's intrinsic value per share is $224, and taking off 20% for margin of safety, it's $180 per share. DCF is the best valuation for Okta right now because Okta hasn't prioritized net margins or net earnings. Rather, it's prioritized cash flow, and so other valuation methods don't work, and DCF is the primary best way. But next, and finally, and last but not least, the ESG consideration. In 2020, Okta launched their ESG program, which has since achieved 100% renewable energy use and has donated millions of dollars in securing identity for thousands of nonprofits around the world. And so ultimately, what we have before us today is a company that is supremely undervalued, has been growing its revenue substantially quarter over quarter, profits quarter over quarter, and ultimately will have huge growth potential in the future. And so for all of these reasons, I recommend a buy. Thank you.